Hello everybody, I'm Sony Mathews, Market Strategist for Geojit Financial Services. With me is Dr. Vijayakumar, Chief Investment Strategist of Geojit Financial Services. So February 1st, we witnessed one of the most anticipated events in the economic calendar of India, the Union Budget 2020, especially since it came in the backdrop of a slowing Indian economy. We expected the government to come out with measures and reforms to set everything right, or at least indicate a roadmap on how they intended to do everything. Now, the budget proposals have been dissected, have been analyzed in detail. In this discussion, we would like to limit it to its impact on the investors or the shareholders. Now, one of the biggest budget proposals that could have an impact on the investors is the abolishing of the dividend distribution tax. The stock markets expected that long-term capital gains tax would go, but instead it was DDT that went. Now, Dr. VK, this DDT dividend distribution tax, it was made tax-free in the hands of investors in 1997, and that is the normal procedure around the world also. Right. Now, the government has gone back to the pre-1997 regime, wherein it will be taxed in the hands of the shareholder. So, will this have an impact on their investment styles, or will the investors change anything about themselves because this DDT was abolished?
Well, the abolition of the dividend distribution tax is a welcome, desirable and progressive move. I say progressive because the dividend distribution tax was a proportional tax which treated all shareholders, whether they are super rich or middle class or retail investor, all of them were treated in the same way. Ideally, a tax should be a progressive tax. So, after the abolition of the dividend distribution tax, the shareholders, that is the dividend receivers, have to bear the burden of tax payment. Right. So, this abolition of dividend distribution tax will have different consequences for different groups of investors. Right. I will explain that in some detail. If you are a mutual fund, then you are favorably placed because mutual funds have the pass-through benefit of taxation. Yes. Right. So, they don't have to pay any tax at all. Foreign portfolio investors who are registered as corporates also stand to gain substantially out of this. As far as retail investors are concerned, if you are a retail investor whose income slab is, say, let us say between 5 to 10 lakh, you gain. Yeah. Because under DDT you are paying 20, exactly. 20.56 to be exact. Yeah. Now, if you are in the income slab of 5 to 10, and if you opt for the new optional income tax regime, where your income tax rate will be 10% for the income 5 to 7.5 lakhs and 15% for the income slab 7.5 to 10 lakhs, you end up paying much lower taxes. So, for that category of investors, this is good. Right. But if you are in the income slab about 10 lakhs, under DDT, the tax incidence was 20%, but now you pay slightly more than 31%. Yeah. So, such people will be adversely impacted. But then this move of abolishing this proportional tax and bringing in the progressive element is good. That is a global practice, actually. Right. But then there is one aspect of this policy decision about which I am a little bit concerned. That is, since it is progressive, take the case of the super rich people, right. People who are getting more than 5 crores of income. Right. They will be mainly entrepreneurs, yes. Right? Yeah. Say an entrepreneur-driven company, and an entrepreneur is declaring dividend, and his income is more than 5 crores. He ends up paying 43% dividend distribution tax, right. Apart from the 22% corporate tax that he is paying. Yeah. This is not the right way, in my assessment, to treat entrepreneurs. Yeah. The government is talking about wealth creation. Yeah. The government is talking about respecting wealth creators. Wealth creators are entrepreneurs, and if entrepreneurs are taxed 22% corporate tax plus 43% dividend tax, that will only discourage enterprise. Right? Entrepreneurs take risk and risk takers has to be properly incentivized. This is disincentive. That is the negative aspect of the dividend distribution tax. Otherwise, for the small investors, as I said, it is advantageous. And this is likely to change the dividend culture itself. For MNCs, this is very good. For foreign portfolio investors, as I said, this is very good. For public sector undertakings, well, they are always forced to pay more dividend to the government, so they will end up paying more. So for MNCs, widely held companies in which there is no conspicuous promoter.
The government, it won't affect their revenues if the...
It won't.
Because PSUs will pay more dividends.
Yes, PSUs will pay more dividends. So the change in the dividend culture will be very positive. Payment of more dividend by the PSUs, MNCs and widely held companies. Whereas for promoter-driven, entrepreneur-driven companies, where the dividend tax incidence will be 43%, they will be looking out for other alternatives, better options.
What options are you?
For them, instead of paying 43% dividend tax, it will be better for them to remain in the old system where they go opt for buyback of shares.
Okay.
In buyback of shares, the rate of tax is much lower.
Right.
So compared to this 43%, you can see from entrepreneur-driven, promoter-driven companies, well, the liberal dividend which they used to pay earlier will not be there, and there can be more buybacks.
Okay. So that is more tax beneficial for the promoters themselves.
Yes, for promoters that will be more tax beneficial. They should be doing that.
Interim dividends, you think before the financial year ends, a lot of interim dividends?
Yes, a lot of interim dividends can come from this category because for this promoter-driven companies, this will be the last chance to pay a dividend.
Themselves.
Yes, themselves at a reasonable rate. Right. Now, this is the dividend distribution part and the transfer of the dividend taxation burden onto the shareholder. In the case of mutual funds also, since dividends are going to be taxed according to the tax slab, the attractiveness of the dividend option is declining.
Yes.
So what advice are we giving to our mutual fund investors in this context?
So as you said, dividend distribution tax for mutual fund investors also will be taxed at the hands of the MF investors. So now, we had two types of investors basically who used to invest in the dividend option of a mutual fund. So one class of investor would be those who are seeking maybe a profit booking from the market or maybe cash in hand. They've invested some money, so they would require some cash in hand. The other class of investors would those who are seeking the regular income. So basically the retired individuals who have no other source of income.
Many had invested in hybrid funds, expecting regular
because
returns.
They used to declare monthly dividends, and that was more or less regular. So these two classes of investors would have been the usual category of investors who are seeking out the dividend option. Now, for the first category of investors who are seeking the occasional income or a profit booking mode of investment, for them the ideal investment would be to shift to the growth option of the mutual funds. And of course, if they require some income or if they require some funds, they can always opt for redemption of their funds. So now the dividend option has lost its attractiveness depending on the tax slab that you are in, as you mentioned. So for a person who is earning more than 10 lakhs or more than 12 lakhs, it would be advisable for him to shift towards the growth option of the mutual funds. For people who are seeking regular income, there is another option in mutual funds which is called as the systematic withdrawal plan. So just like you have SIPs, you have SWPs, which is a systematic withdrawal option. So depending on your monthly requirement of funds, you can opt for the SWP. You can say, okay, this is the amount that you want on a monthly basis.
So there is no incidence of tax there. It's only
there is only the capital gains tax. So it is much more tax beneficial than the dividend option, because in the short term, if you have, short term in the sense before 1 year when you are redeeming it, if you have any capital gains, it will be taxed at only 15%. Now, after 1 year, you get the benefit of that 1 lakh,
1 lakh completely
is exempted. Above 1 lakh, you are charged only at 10%. So it becomes much more tax beneficial on a long term basis, because after 1 year, your up to 1 lakh is tax free, and above that you just need to pay 10%. So the only thing that we need to keep in mind over here is the exit load that some mutual funds may charge, because usually the funds charge an exit load if you redeem it before 1 year, and there is no exit load if it is after 1 year. So these are a couple of things that we need to keep in mind. But then dividend option has lost its attractiveness. For those who want regular income, opt for the SWP. Young investors who are earning, who have a regular salary, should definitely go for the growth option. They should not go for the dividend option. So of course, there is TDS on your dividend income, up to above 5,000 rupees, 10% might be charged at TDS. So,
but then all TDS is refundable.
If you don't fall in that tax. So again, it all comes down to choosing the right income tax slab. I mean, so as you were mentioning earlier, we have now two options in front of us. So you have the old regime and you have the new regime. So I would like your views on, so you indicated it a little bit, but then I want your views on how this will actually impact, the savings and investment of the Indian people on a whole, because, we need to choose which option to go for, and how that can have an impact on the savings culture of India.
Okay. This new optional income tax regime introduced by the finance minister is simple. That simplicity has to be accepted because there are no exemptions at all. But then for millennials, people like, the people who are described as millennials, the young generation, their focus is always on consumption. So if they are given some tax relief, their propensity to consume will increase, and that boost in consumption may help the economy also to overcome the slowdown that we are facing. That must be one of the factors that prompted the finance minister to go for this optional income tax regime. But I have a concern as an economist looking at the macroeconomic dimension. My concern is this kind of income tax regime without any exemptions will discourage savings. In the older tax regime, we had what is existing now, and you have the option to continue with that. That is the positive part. There, because of exemptions like ATC, a large number of investors were forcibly saving money, and this forced savings have done them a world of good. Look at the portfolio of mutual funds of people who have been doing systematic plans in ELSS for the last 10 years, 15 years, 20 years, fantastic returns. Far superior to the returns from fixed deposits, gold about it. So that forced saving in a country like India, where the financial literacy levels are even now very low, you need a lot of hand holding and also a little bit of nudging to encourage people to save more. So with this kinds of complete removal of incentives for saving, the total savings in the economy might decline. Already a very concerning macroeconomic trend is the decline in financial savings in the economy. When financial savings decline, the total pool of savings available in the economy to be mobilized for investment declines. That will adversely impact growth. So from the growth perspective and macro perspective, in the long run, this removal of exemptions is not a good idea.
So, and even I guess even for insurance also, it is underpenetrated. Most of the populace also does not have any insurance plan. So
that's right.
The earlier regime would have acted as an incentive to have your insurance, but then it can have an impact, especially in a country like India. In US, of course, everything is covered under the 401k. So over here, I think that would have benefited a lot of people.
That's right. But then a large number of people, particularly the salaried class, are likely to continue in the old regime because they have a lot of exemptions like standard deduction and all that. So for them it will be better to remain in the old regime.
Okay. So now the budget anyway done and dusted. Many people have said that it was a non-event and you should not even consider it. You know, when you are looking at the stock markets, you need to focus on the fundamentals. Now, what would be your now going forward expectations from the stock markets?
That observation is right. It has only a short-term impact. There will be huge volatility on the day of the budget, after the budget, then it will stabilize. It's actually a non-event from the long-term perspective. In the medium to long run, the trend of the market will be determined, even dictated by the fundamentals. A very important point that we have to keep in mind in the present context is, if you take the last 3 years, market movements are completely global and synchronized. In 2017, we had a global bull run. In 2018, globally markets were bearish in spite of good economic performance, because there was capital outflows because the Fed started tightening the monetary policy. Again in 2019, globally markets were bullish. Even India, with very poor economic performance and tepid corporate earnings, Nifty delivered 12%. So market movements are likely to be globally synchronized. There will be global trends. So investors should watch for global trends more than other factors. Of course, Indian economy's recovery and earnings recovery will be important.
Thank you, Dr. Vijayakumar.